Okay, the purpose of this video is to give a brief introduction to how to deal with a capital lease. And so it's going to give a very simple scenario. Let's look at this together. So the lessor has a piece of equipment on their books for $1 million, and they're going to lease it to lessee company. And here's the description of the lease. The equipment on the books is recorded at cost, $1 million, and its current fair market value is estimated to be $1.5 million. Lessor company leased the equipment to lessee company for 5 years for annual lease payments of, so they're going to determine what those lease payments need to be, due on each January 1. The first lease payment is made at the beginning of the lease. Title passes to the lessee at the end of the lease. And at that time, the expected life of the equipment will be for 3 more years, so 8 years total. And the lessor will include an implicit rate of 8% as they're determining what those payments need to be. So the lessee, when they come up with the lessor, when they come up with the payments, they want a fair market value of $1.5 million, and they're going to have 5 payments at the beginning of each of the next 5 years. So remember, if you cover up that first one, they actually have a 4-year ordinary annuity. So you would look up that table factor, a 4-year ordinary annuity at 8%, and then add 1 to it, and you get 4.31213. So the formula that needs to be solved is a 1.5 million fair market value or present value is going to be equal to some payment times that table factor. So the 1.5 million divided by the table factor gives us a payment of $347,856. So that's the payment that we're going to factor into this problem. So let me skip over here to the layout. So we have 5 payments of $347,856. The present value of those, discounted at 8%, is $1.5 million. You could do that, take that using the table factor that we computed a minute ago, or you could find the present value of each one of those items and add them up, and we get to $1.5 million. So the lessor is going to pretend, so that's what the accounting does. We are accounting for this as though the lessor sold it to the lessee, and the lessee is going to account for it as though they purchased it. So the lessor would record a lease receivable and a sale of $1.5 million. They would also record cost of goods sold of $1 million when they take that equipment off the books. And initially, of course, they would have the very first payment right there at the very beginning too. So as of the end of day 1, we have, the 1.5 million receivable offset by the collection. So we have a beginning balance in the receivable at the beginning of year 1 of $1152,144. They're going to accrue, at the end of the first year, they will accrue 8% interest on that, which is $92,172. And so they will grow the receivable by that amount and count that as interest income. So in the first year of the lease, the lessor is going to have gross profit on the sale of $500,000, plus they'll also have interest income on that lease receivable of $92,172. Then at the beginning, on the day 1 of year 2, they'll have another collection, and so the process continues all the way through the 5th year. Now the lessee, let's look at it. The lessee, again, has a present value of $1.5 million. They're going to use the implicit rate of the lessor if they know it. If they don't know it, they'd have to use their incremental borrowing rate, but we do know it. So we're going to record a $1.5 million purchase, debit a right of use asset, and credit a lease payable for 1.5 million. Over, and then of course they'll have the initial collection. And so at the end of the first day, the beginning of the first year, we have that 1152, 144 lease payable. That lease payable will accrue interest at 8%. So the lessee will debit interest expense and credit the lease payable. They will also amortize this right of use asset. Now, how long are they going to amortize it over? Well, they're going to amortize it over whatever period of time they're expected to use it. Since the title transfers at the end of the 5th year, and it has 3 more years in its life, so they'll amortize it over a total of 8 years. And so we would debit amortization expense and credit the right of use asset for that 1.5 million divided by 8, which is 187,500. So the reason we did that, if we go back to the classifications, unless a lease is for 12 months or less, that's called a short-term lease. If it's a short-term lease, we're just going to record the payments as rent expense, straight line over, the 12 months or whatever the number of months involved. But for any lease longer than 12 months, the lessee is going to record this as like a purchase. We're going to debit the right of use asset and credit the lease liability. That's for every lease over 12 months. And then if it meets one of the criteria that we talked about, it'll be called a finance lease, and we will record both interest expense and amortization expense. If it doesn't meet one of those criteria, we'll just lump all the expense together and just call it an operating expense or lease expense over time. So the other videos get into more detail with that, but that's the big picture, the simple lease.